Welcome to today's Lunch and Learn webinar. This is Tony King with Sigma Actuarial, continuing our conversation about projecting losses in times of uncertainty. If you recall, our last Lunch and Learn webinar was on this topic, and we're going to kind of continue that conversation today, specifically talking about loss development factors. And as per usual, I'm joined by Enoch Starnes and Michelle Bradley. Hello, Enoch.
Hey, Tony.
And welcome, Michelle.
Hello, everyone.
Thank you for joining us again today. And just kind of overview of today, we're going to start with, I'll give us a quick context and timeline about what's going on with COVID. Enoch's going to walk us through measuring the impact. All three of us will kind of talk about some key considerations for LDS, and then we'll wrap it up with a couple of conclusions. So just in case anybody's forgotten about what's been going on the last 6 months, the context here is uncertainty can stem from any number of situations, and certainly we're in one of those situations now. But in all honesty, what we're talking about today can be applied in several different ways. We're going to talk specifically about COVID-19 and how you would use it in this situation, but it can be used in other situations as well. And our basic thought here is the best way to process all this information is through analytics. And again, we've talked about this before. The process of analytics is you monitor what's going on, you analyze, you adjust, and repeat. You're constantly adjusting and trying to hone in on where the best place to be. And again, a basic timeline. As we back in the olden times in January and February, things were working as normal. Starting in mid-March is when a lot of the shutdowns started to happen. In early May, things began reopening, and we almost got out of mid-July here of some regression, of some more things shutting down a bit more, depending on what state you're in. There certainly has been. I don't know that we're where we thought we would be, so it's still kind of dragging on there. And that gets us to measuring the impact. So I'm going to hand that over to Enoch.
Sure, thank you, Tony. So before we cover the graphic, I wanted to give you guys a quick background on why we're focusing on LDF specifically today. Loss development factors are often vital parts of an actuarial analysis that allow actuaries to estimate ultimate losses for historical periods. And these estimates are then used when projecting future losses. So in order to ensure the loss projection you're using for renewal or accrual purposes is reasonable, you'll want to analyze the impact of whatever abnormal situation your company is experiencing. The current pandemic is a great example of this, but as Tony said, it's not necessarily the only one. You could use this type of analysis in many different situations. Moving on to the graphic itself, in most circumstances, you would want to examine your company's unique loss development triangle, specifically the portion reflecting your current loss experience, or in other words, the current diagonal. So let's take a look at this example. This is a pretty common type of loss development triangle, looking at loss experience every 12 months. The top portion shows the actual loss experience, and the bottom portion shows the age-to-age factors measuring the actual development over time. So for an example, if we look at the 2017 year up top, you can see that after 12 months in 2017, we had about $218,000 of incurred losses. And then 12 months later, when that period was 24 months old, there were $311,000 of incurred losses. And you can see that quantified or measured in the portion below, in that 12 to 24 month age-to-age factor of 1.427. So that's meaning that the losses in that period grew about 42.7% over that 12-month period. So the current diagonal that we would be looking for is shown by the red boxes there. And as you can see, that current diagonal is obviously unfilled. This highlights a very important issue that we're facing right now. To fill these in accurately, you would need loss data evaluated as of 12/31/20, which of course isn't available yet. You could fill it in with current data, but it wouldn't necessarily be a consistent comparison, as previous measurements represent 12-month intervals. So on the next slide, we'll see a way to work with the data that we currently have. This is called a loss emergence analysis. What we're doing here is comparing the development we expected based on our company's unique loss history with what's actually occurring. Doing so let us analyze whether or not the situation we're experiencing is impacting loss development, and if so, to what degree. In the interest of time, we don't want to get too bogged down with the details of this, but I'll try to briefly cover how this type of analysis is constructed. So on the left-hand side, we have the reported losses as of 12/31/19. This would be straight off the loss run. And if you noticed on the previous slide, this is actually the most recently filled in diagonal. After that, we have the projected 6-month LDFs. This is taking the LDFs that were applied at year-end 2019 and dividing them by the LDFs that would be applied at 6/30/20. Now, there are a number of ways of obtaining these LDFs, but in the interest of time, we won't dive into all the different ways you would obtain those. This calculation shows the development we would have expected over the last 6 months. Now, it's important to note here that this could be used for any interval of time, not just 6 months. So after that, we have the reported losses as of 6/30/20. And this, again, is just straight off the loss run, and we're dropping in our newly available incurred losses evaluated as of 6/30. Now that we have the actual losses, we can calculate what's referred to as the emergence over the past 6 months by dividing the 6/30/20 losses by the 12/31/19 losses. You can think of these as the actual development factors for that 6-month period. And then finally, we're calculating a simple ratio between the actual emergence and the projected LDFs, or in other words, the projected emergence. This is how we can measure the potential impact that our abnormal situation is having on loss development. As you can see in this example, 2013 through 2017 aren't showing much deviation from expectations, but 2018 and 2019 are showing fairly significant differences. Since they're higher than expectations, this could indicate a potential deteriorating trend and would then be used to help determine future adjustments. You'll want to remember 2 important things though. First, these metrics are not measuring the full 12-month development, so they should be examined knowing that the more recent periods are still fairly immature and development will still be volatile. Second, a relatively simple exhibit such as this is not taking any context into account. We'll get into a number of ways you can account for context momentarily, but as a quick example, you could consider the type of business producing these losses and whether or not seasonality plays a role in mid-year experience. So before we get into understanding that context, I wanted to see if Tony or Michelle have any additional comments or feedback on this.
Thanks, Enoch. I would just like to add that an emergence table like this is very useful in other times as well. We have other clients that use an emergence table, particularly if they only do 1 report a year because they constantly want to monitor what is happening. So this is a tool that's been around a while, but it's a tool that is particularly useful in this situation where we're facing uncertain times.
Anything else, Enoch?
No, that's good.
Okay, thank you both. And I'll take us to the next slide. So we're going to spend a few minutes talking about some key considerations then, and I'll walk us through the first few of these. And these are questions that you really would talk about internally and with your your risk manager and perhaps with your actuary and your broker as well about what you're seeing and what the reasons and the thoughts behind those changes are. The first question is, what constitutes real change? And that's really looking at your own loss history. And in order to do that, I'm going to sneak back to that first measuring the impact slide and kind of look off Enoch's example. You look at those 12 to 24 month factors. So you can see within 6 years of history there, a fairly tight range of LDFs there, from a low of just under 34% to a high of about 47. So if when we get to the point that we start filling this in, if we get something in like 35, that would be lower than the average and lower than what we expected. But we might not necessarily call it quote unquote real change because it's within what has been happening during normal time. If, however, you get something like 1.2 or 1.6 here, you begin to start to think, okay, that is this real change because it's outside what is quote unquote normal. So that's what we're talking about with real change. A second question is, if there's improvement or deterioration, how long will it last? And that's a key question. And part of that is just understanding, what precipitated that improvement or deterioration. If you've got a safety program, and that's kind of what we talk about here in a bit more as well on the next question. If you have a new safety program, maybe there'll be some immediate benefit of that. But if you don't, if it's a one-time program and you don't keep that culture going over the course of time, that might fade away. And certainly now with the pandemic and the COVID situation, none of us really know how long this is going to last and what the long-lasting impacts of development on loss development might be. It's good to talk about it, and we've got a lot of clients that we're doing sensitivity analyses with, where we're doing a report analyses a couple ways. One of which we're saying, okay, we've got this new LDF down at 1.2. Let's assume that it holds that way for the rest of the year. And we'll do it that way. Okay, let's assume that it reverts back to normal for the rest of the year. That's kind of your analysis B. And your analysis C is let's assume that it catches back up the rest of the year. All that suppressed development that didn't happen, maybe during the second quarter, is all going to happen in the fourth quarter. And so you can do it different ways and kind of get a sensitivity analysis and have a reasonable range that we expect the losses to develop within this range of possibilities. The third question we have here, which I kind of snuck up on, is, are any of the measured changes likely to be anomalous? So is it just a blip? And that's always the big question. Back to my example here, actuarially, if we see a 1.2 there, our tendency is to think of it as a blip. That that's unusual, and we don't necessarily expect it to repeat. But that's where in normal times, again, we would have discussion with the client. Okay, did something change? Why did that happen? What's going on there? What we would do right now, in all honesty, and with the pandemic, is we'd probably switch over and look at frequencies as well. Is this, am I seeing that my frequency count is down to 75% of usual? Well, okay, my LDF is about 75% of usual, so that makes sense, that there's just fewer claims. And that gets kind of into our last session is, has there been a shutdown where people not working during this time, where there's some furloughed workers, all those things that might explain, which would tend to make it more of an explanation behind a blip, that okay, this was a short-term thing that will not be repeated. So we don't expect it to continue, and there might be a catch-up later. Any other comments from anybody on that? I'm going to hand it over to Enoch then for the other key considerations we have.
Thanks, Tony. So yeah, I'll cover these last three questions here. So the first is, are decreases in frequency or overall exposure being contemplated? And this kind of goes back to what Tony was just talking about. And it plays a little back into what we mentioned earlier, somewhat regarding seasonality. So more than likely, businesses in our current situation are still operating in a limited or somewhat altered, possibly, capacity, which may impact the volume of claims coming in. And while this may not necessarily affect development, it's an important step in making sure you have a full understanding of your current loss experience. It's a good check, like Tony mentioned earlier. Are the potential impacts of regulatory or judiciary changes being recognized? This one's fairly self-explanatory. Depending on the judicial or regulatory environment impacting the program, there may be recent changes in requirements on claim filings or legal precedents that will need to be understood in some capacity. This type of context may not be fully understood for some time in our current situation, though, so keep that in mind as well. And finally, is there an understanding of what causes new trends in loss development? So even if metrics like claim frequency are being impacted, these won't necessarily lead to loss development trends. More common examples of drivers are adjustments to the way claims are handled in terms of reserving or payment practices, or changes in claim severity. Claim mixture is another important item to consider right now, as businesses are most likely seeing relatively significant changes for their incoming claims as compared to historical experience. Finally, you want to keep a close eye on emerging claim types, because as it says on the slide, these may develop quite differently than historical claim types. And before we get into the conclusions coming up here, I just wanted to check again with Michelle or Tony.
Yeah, I would just like to add that within the context of everything we've talked about, At the end of the day, whether you're doing a reserve analysis, which is looking back at the years that are in place, or you're looking forward with a loss projection, what you're trying to do when you have retained liabilities is the management of the firm needs to come up with management's best estimate. And they do that with actuarial support and guidance. And in both situations, the range of uncertainty has likely increased dramatically, which means more conversation needs to happen about loss development factors and how that affects prior years, and loss development factors in turn, when it affects those prior years, how does that move forward and affect the loss projection? So there may need to be conversations about the actuarial reserve range, but since we're talking about loss projections today, maybe more conversations about the statistical variation that could be around the loss projection going forward based on what you're observing with these loss development factors.
I've got a point too, and I'll just cut in and remind folks we've got a couple questions in, but if you need to use the sidebar to ask any other questions, please let us know. Something I wanted to add there about kind of the building on what Michelle said and Enoch as well is regard to claim mixture specifically in the current year. We're asking a lot of clients to separate how they look at 2020 and the impact on all prior years. The impact on the prior years is really more the fact that the claims are already in, obviously, for the most part. They're just not developing the same way, perhaps. So there may be an impact on development on the prior years that way. But for the current year, it can really impact the claim mixture and the seasonality of everything as well. If you're in a situation where it's shut down, you shut down for a couple months and no claims came in that period, and then claims resumed, say in June, that's going to impact your seasonality for the year as a whole. If you think of a typical year, when you get to the end of the year, you expect an average claim to be 6 months old. But in a year like 2020, if you were shut down during March through June or July, and you really didn't have any claim activity, and then it's like things do open back up in August and your claims start coming in again, you're going to have a much younger portfolio of losses perhaps there, because majority of your claims maybe came in the second half of the year. Alternatively, if things don't open back up at all, and the only majority of your claims were in January, February, and early March, you're going to have a much older claim portfolio than typical. So 2020 is going to have to be looked at, probably separately for a while, just because it won't, the age of the claims alone won't be the same as a typical year will look like. So it's something to look at there.
Yeah, and I would just add, based on what Tony said, if you look at the triangle where we highlighted the red and it forms like a diagonal of the triangle, I think just to take what Tony said a little further, if you look at just the current year, which is 2020, that's going to be a horizontal line that ends up going across for 2020 as the triangle becomes filled in over time. But I agree that 2020 is going to be a year that the age-to-age development factors are going to have to be tracked and reviewed for quite some time.
Perfect. So a few conclusions. One is, which I think we've all kind of touched on already several times, is the impacts on loss development factors will inherently affect the loss projections. So as we make these adjustments to the historical years, that's going to also impact our projections for the current year and for 2021, which we'll begin looking at shortly. A great way of looking at this is doing mid-year, quarterly, and bi-monthly examinations. And the idea there isn't necessarily that you change anything significant during that time, but it gives you more information so that when you get to year end, you've had a snapshot of what things look like at 6:30, of what things look like at 9:30, so that you don't overreact at year end. That's kind of the point of the next conclusion there. You shouldn't necessarily change your LDFs quite a bit. In this example, we showed that I think in 18 and 19 that development was coming in higher than usual, but that doesn't mean, oh well, we need to increase our LDFs all of a sudden. It's really more just informational. So through June things were high. Let's look at it again at 9:30 and see where we stand then. Are we still high? Did they come down a little bit? Don't overreact and apply a higher LDF to already higher reported losses, or vice versa, and maybe move further away from the norm. And then just to continuing again back to our analyze, adjust, repeat. You should use these methods to inform your future changes in discussion, and always come back and monitor them and make further changes as necessary. And I think our last thing, I'll hand back to Enoch here.
Thanks, Tony. So as you might imagine, as actuaries, we spend a lot of time discussing and writing about LDFs. So we have a wealth of knowledge in this area that may be helpful to you if you'd like to gain a better understanding. If so, you can search for the following articles on our website, riskmanagementblog.com. I'll briefly cover these so you'll know which you may want to seek out. So the first is understanding loss development factors. For some of our audience, this may be your first time really digging into a topic involving LDFs. And if that's the case, this is actually a more in-depth article that works through how exactly LDFs are created and then used within an actuarial report. The next is titled Common Mistakes Using Loss Development Factors. This is also a great article to review if you're using LDFs in your work from time to time, but aren't necessarily doing so every day. It lists several mistakes to watch out for and how to make sure you're avoiding them in your work. The next is titled Understanding Actuarial Methods, and it's a great overview of a number of different methods actuaries use to estimate ultimate losses, and it includes the development methods, which rely on LDFs. So this is a good one to review if you want to see when exactly LDFs start to come into play in an actuarial analysis. Next is a conversation on loss development factors. And this is an interview style Q&A with our very own Tony King, which talks about the different nuances surrounding LDFs. This is a good one to review if you're already pretty familiar with LDFs and would like a slightly more advanced understanding. And finally, we have the analytically based data-driven broker on loss development factors. So this is just a quick article that looks at specifically how loss development triangles are created. And it also has a quick discussion on industry sources. So this is another good one to review for anyone who is newer to looking at LDFs and understanding how they're used. And again, that's all on our blog, riskmanagementblog.com.
And I'll just mention, if you'd like to subscribe to the blog, you can go to sigmaxray.com and as Enoch said, Risk Management Blog, and you can subscribe here. We have had a couple of other blogs about projecting losses in times of uncertainty that we probably won't cover in the Lunch and Learn, but you can still subscribe to the blogs and read about them here. And I think the questions we had, we all pretty much covered during the course of our conversation today. So not seeing anything else, I think we're going to wrap up. Nobody else has any final thoughts. So again, this is Tony King signing off. Thank you for joining us today, and hope you all have a great day and stay safe.
Thanks, everyone.
Thank you all.